key things driving the U.S. equity markets in the fourth quarter were, first of all, the tax bill. So we've been talking about the tax bill all year, but now it's really come to fruition, and it's happened a little bit faster than expected. And when you look at it, not everybody's happy about it, but the features for corporations, in particular the reduction in the corporate tax rate from 35% to 20% or 22%, is very good for U.S. corporations. And that's definitely been a spur. The next thing that's been a big factor is the strength of the U.S. economy. It looks highly likely that the GDP growth for the whole year will be about 3% and also into 2018. So that kind of backdrop has caused a shift in the market, a rotation away from the high flyers that were driving the market to this point and into the more value and cyclical type names that have lagged. The appreciation portfolio is a really good portfolio to own right now. So our goal is to beat the market over the cycle, but to do it with materially less risk. When you have a year like this one where the market's up 20%, we're going to tend to lag just because we're a conservative portfolio. That said, we're going to be up a lot. We're just not up quite as much as the market. And we're going to then protect you when the market inevitably goes down. And especially given valuations right now, that's a risk. So we have suffered this year from not owning really aggressive names. So companies that don't generate an awful lot of cash flow or burn a lot of cash flow as part of their business model. Companies like Tesla or Netflix, they're fine companies, but they're too risky for us to invest in. Those have been some of the best performers in the market. Well, this shift that we've seen in the fourth quarter, where we've moved away from some of the high flyers and towards the more cyclicals and the laggards, has benefited us. The good news is that the economy continues to be awesome and the rest of the world continues to be awesome. And we just hit a new high in the leading economic indicator, and usually, at least for 18 months after that, you don't have a recession. So the picture from the economic standpoint is good. That means earnings growth is probably going to be good, probably high single digits. And so the market probably continues to do okay. The bad news is that valuations are so extraordinarily high that it's hard to imagine that you're going to have much increase in PEs or in valuation measures. So I would point at kind of two things that I'm watching. The first would be the Mueller investigation. So if that goes badly, we have to watch out. Watergate was very bad for the US market. The second thing that concerns me is interest rates and the shape of the yield curve. So one of the things that we have to watch out for is that the yield curve right now has flattened. And so now the 10-year interest rate is only about 50 basis points more than the 2-year. If that inverts, so the 10-year rate is lower than the 2-year, well, historically, every time you've had an inversion, 18 months later, you've had a recession. So we need to be careful about the shape of the yield curve and how aggressive the Fed is in raising rates. If the economy continues to be strong, what will happen is that long rates will probably rise. And so even though the Fed raises rates, you'll still have a positive slope to it. But we do have to watch it. And we are 9 years into a recovery. And so recessions at some point will happen. Excesses build in the economy.